For 30 years, we were sold a myth. It was the narrative of the garage dreamer, the idea that Silicon Valley was a magical meritocracy where people in hoodies just wanted to organize the world's information or move fast and break things. But look at the skyline of San Francisco or the balance sheets in Redmond today, and you'll see that the dream has been replaced by a cold mathematical reality. By 2026, the Big Five, Apple, Google, Microsoft, Amazon, and Meta, have evolved into something far beyond tech companies. They are no longer just selling you phones or social media feeds. They have become the largest, most sophisticated financial engines in human history. If you peel back the UI, a transformation emerges. These companies are now massive hedge funds disguised as tech entities. They are utilizing a financial engineering glitch to manipulate markets, stifle rivals, and colonize the global economy. They have become too big to fail, woven into the DNA of national security and global trade. Today, we go inside the machine to see how they really run the world. Chapter 1. The Buyback King, the Apple Secret. Visual, a graph showing Apple's stock price skyrocketing while its R&D spending as a percentage of revenue remains relatively flat. To understand the glitch, you have to look at the master of the game. Apple. For years, critics have complained that the iPhone hasn't truly changed since 2018. They're right, but they're missing the point. Apple's most successful product isn't the Vision Pro or the titanium casing, it's financial engineering. When a company's innovation slows, they face a problem. How do you keep the stock price going up? The answer is the stock buyback. Apple uses its mountain of cash to buy its own shares off the open market and retire them. This reduces the total supply. According to the law of supply and demand, if there are fewer shares, each remaining share becomes more valuable, even if the company didn't sell a single extra phone. Since 2012, Apple has spent over $650 billion on buybacks. To put that in perspective, that is more than the total market value of ExxonMobil or Walmart. They aren't just a tech company, they are a vacuum cleaner for their own equity. The glitch. Even when these giants have cash, they often borrow money to do this. Because of their massive credit ratings, they can issue bonds at 3% interest, use that money to buy back stock that yields a 7% return in growth, and pocket the difference. It is free money, created out of thin air, fueled by the debt markets. Chapter 2. The Kill Zone and the Data Tax. Visual, a map of companies acquired by Meta and Google over the last decade. A graveyard of startups. In the old world, if you had a better idea, you won. In the new world, if you have a better idea, you enter the kill zone. This is a term used by venture capitalists to describe the space around a big tech giant where no startup can survive. Take Meta. When Instagram and WhatsApp became threats, Mark Zuckerberg didn't try to out-innovate them. He simply wrote a check. But for those who refuse to sell, look at Snapchat. When they turned down a buyout, Meta systematically copied every single one of their features, stories, filters, disappearing messages, and used their 3 billion user scale to starve Snapchat of oxygen. The Amazon method. Amazon is even more surgical. They operate the world's largest marketplace, which gives them a God view of global commerce. If a small business starts selling a unique backpack that goes viral, Amazon's algorithms see it instantly. Within months, an Amazon Basics version appears, priced at a loss, placed at the top of the search results. They use your own data to bankrupt you. This isn't competition, it's a digital toll booth. You either pay the giant a 30% Apple tax or Amazon commission, or you are erased from the internet. Chapter 3. The Dopamine Economy. Visual close-up of a person scrolling through TikTok Reels, the blue light reflecting in their eyes. The product isn't the app, the product is you. We've heard that data is the new oil, but that's an understatement. Oil is a raw material. Attention is a biological necessity. Big tech has hired thousands of neuroscientists to map the human brain's reward centers. Features like the infinite scroll were modeled after Las Vegas slot machines. They trigger a dopamine hit every time you pull down to refresh. Why does this matter for Wall Street? Because Time on device is a leading indicator of profit. The more you scroll, the more certainty these companies can sell to advertisers. They aren't just guessing what you'll buy, they are using AI to predict your behavior with 95% accuracy. By turning the human experience into a predictable data stream, they have turned the NASDAQ into a giant betting parlor where the house, big tech, always knows the outcome. Chapter 4. The Invisible Empire, the Shadow Owners. A complex web connecting BlackRock, Vanguard, and State Street to the boards of every major tech company. Now we have to ask, who is actually allowing this to happen? Why don't regulators stop it? The answer lies in the revolving door. Big tech spends more on lobbying than the tobacco and oil industries combined. They hire former senators, AGs, and Department of Justice officials to run their policy departments. But the real power is held by the shadow banks. If you look at the top shareholders of Apple, Microsoft, and Google, you will see the same three names: BlackRock, Vanguard, and State Street. These big three manage over $25 trillion in assets. They own the tech companies, but they also own the banks that lend them money for the buybacks. It is a closed-loop system where the owners of the world's data are also the owners of the world's debt. This is why these companies are now considered essential infrastructure. If Microsoft's cloud goes down, the global economy stops. If Amazon's logistics fail, the food supply chain breaks. They have made themselves too important to be regulated. Conclusion: the bubble history tells us that no empire is permanent. From the Dutch East India Company to Standard Oil, every monopoly eventually meets its match, whether through a market crash, a new technology like decentralized AI, or a societal breaking point. The infinite money glitch has made a few people unimaginably wealthy, but it has come at the cost of our privacy, our mental health, and the very idea of a free market. The system is more fragile than it looks. The bigger the bubble, the louder the pop. Next video tease. In our next deep dive, we are going inside the shadow banks, the firms that actually control the big three. We'll show you the algorithms that are now making trillion-dollar decisions without human intervention. Click subscribe to join us as we follow the money. Welcome to Wealth Footnotes.